Welcome to The Explainer. Today, we're diving into something that's one of the most watched and honestly one of the most feared indicators in all of finance. We're talking about the yield curve.
So, let me ask you this. Can a single line on a graph actually predict the future of the economy? I know, it sounds a little bit like science fiction, right? But for decades, this one simple line has been something investors have been absolutely glued to.
And look, this isn't just some abstract theory. It has a serious track record. Just take a look at the lead up to the 2008 global financial crisis. Back in 2006, the yield curve did this weird thing. It inverted. It was like a warning bell. Then, sure enough, in 2007, we started seeing the first signs of real financial stress. And by 2008, well, we all know what happened. The whole crisis kicked off. This pattern, this inversion followed by a recession, it's not a fluke. It's happened over and over, and it's exactly why economists and investors pay so much attention.
All right, so the big question is this thing really a crystal ball for recessions? Let's dig into the power of this famous economic indicator.
Okay, so this predictive line we keep mentioning, it's called the yield curve. And really, it's a tool investors use for all sorts of things. But most importantly, for trying to get a read on where interest rates and, the whole economy might be going.
But before we can get into what it's telling us, we kind of have to understand what it is. So let's start from the ground up and talk about how you actually build a yield curve.
At its core, the yield curve is just a graph. It's pretty simple, really. On one side, you've got the yield. You can just think of that as the interest rate an investor gets back. And on the bottom, you've got the maturity date, which is just a fancy way of saying how long until you get your money back.
So the most common one that everyone watches uses U.S. government bonds, or Treasuries. All you do is you take the interest rate, the yield, for a 3-month bond, a 2-year bond, a 10-year, all the way up to a 30-year bond. You put those points on the graph, connect the dots, and boom, you've got yourself a yield curve.
The key thing to get here is that the yield curve is like a snapshot in time. It's telling you right now, today, how much extra you're getting paid to lend your money out for, say, 10 years versus just a few months. It's all about that classic trade-off, risk versus reward over time. Okay, so we know how to build it. Now for the fun part, decoding what it's actually trying to tell us. The whole secret is in the shape of the curve, and there are really only 3 main shapes you need to know.
First up, we've got the normal curve. This is the shape you see most of the time. It's what things are supposed to look like.
A normal curve slopes upward from left to right. And this just makes sense, right? I mean, you'd expect to get a higher interest rate for locking up your money for 30 years compared to just 3 months. There's more risk, like inflation eating away at your money. So when the curve looks like this, it's a good sign. It means investors are generally feeling optimistic. They think the economy is going to grow, and they expect to be paid a little extra for that long-term bet.
All right, now for the one that gets all the headlines, the one that causes all the panic. Remember 2006? We're talking about the inverted curve. This is where things start to get, well, weird.
So you can see the difference right here. With a normal curve, longer loans mean higher interest rates. Simple. But with an inverted curve, it's the total opposite. You actually get paid less to lend your money for a long time than for a short time. It just flips common sense completely on its head. And it's a huge red flag that investors are seriously concerned about what's coming.
So why on earth would this happen? Well, it all comes down to fear. Investors start to worry that a recession is on the horizon. They think the central bank is going to have to slash interest rates in the future to save the economy. So what do? They scramble to buy long-term bonds right now to lock in today's rates before they fall. This massive rush of demand for long-term bonds pushes their yields down, way down, so much that they actually dip below the short-term yields. And that's how the curve inverts.
Okay, and that brings us to our third and final shape. This one's kind of the in-between state. It's the flat curve.
And a flat curve is pretty much what it sounds like. It's almost a horizontal line. There's barely any difference between what you earn on a short-term bond and a long-term one. You can think of it as the market holding its breath. It's a time of major uncertainty, often showing up when the economy is at a crossroads, transitioning from good times to bad, or maybe, hopefully, from bad back to good. So let's recap real quick. Normal means growth, inverted is a recession warning, and flat means uncertainty. Got it? Okay, so now let's put it all together and talk about what these signals actually mean for you. But, and this is a really important but, this is where we have to be super careful. I love this quote because it really hits the nail on the head. Trying to speculate or time the market based on the yield curve, it's a really risky game. It can totally derail you from your actual long-term financial goals.
So here's the bottom line. The yield curve is an incredible indicator. It's one of the best we've got, for sure. But it is not, and I'll say it again, it is not an instruction manual. Just because you see an inversion doesn't mean you should panic and sell everything you own. It's a sign to be aware, to be thoughtful, and to be strategic.
So, instead of trying to predict the future, what do? Well, the experts generally point to a few key strategies. Number 1, diversify. Make sure your portfolio is spread out across different types of bonds, different time frames, different risk levels. That way you're not putting all your eggs in one basket. Number 2, stick to your plan. Make sure your investments are aligned with your own personal goals and how much risk you're comfortable with. Don't let the scary headlines change your entire strategy. And number 3, you might want to look into something called laddering. It's basically where you buy bonds that mature at different times. That way, you've always got some cash coming available, which lets you adapt more smoothly to whatever interest rates are doing.
And all of this leaves us with one big final question to chew on. Is the yield curve some kind of magical crystal ball that can actually see the future? Or is it just a mirror? A mirror that's reflecting back the collective hopes and, more importantly, the collective fears of millions of investors all at once. Maybe the real answer is that it's a little bit of both.